Good day, and welcome to the Fitbit second quarter 2018 earnings call. This call is being recorded. At this time, I would like to turn the conference over to Tom Hudson. Please go ahead, sir.
Good afternoon and welcome. Fitbit distributed a press release detailing its quarterly results earlier this afternoon. It's posted on our website at www.fitbit.com and also available from normal financial news sources. This conference call is being webcast live on the Investor Relations page of our website, where a replay will be archived. On this call, all financial measures are presented on a non-GAAP basis except for revenue, which is a GAAP measure. A reconciliation of GAAP to non-GAAP financial measures is provided in our posted earnings release or in other earnings presentation materials posted on the Investor Relations page of our website. This conference call will contain forward-looking information which is subject to risks and uncertainties described in Fitbit's filings with the SEC and in today's press release. Actual results or events may differ materially. We will begin with a commentary from James and Ron, and will then open the call to questions. We are going to limit the call to about an hour, so we apologize in advance if we don't get to all your questions. Let me introduce Fitbit's Chairman and CEO, James Park. James?
Thank you, Tom. Thank you to everyone participating in today's call. I am pleased to report that for the sixth quarter in a row, we have delivered on our financial commitments and are making progress in our multi-year transition, which include adapting to the changing wearable device market, transforming the business from an episodic-driven model centered around device sales to more non-device recurring revenue, deepening our reach into healthcare, and increasing our agility and optimizing our cost structure. Revenue for the quarter was $299 million. We saw continued momentum for our mass appeal smartwatch, Fitbit Versa, which sold out in the quarter. The introduction of Versa strengthened our brand and relevancy and highlights the opportunity to regain market share as we progress in the smartwatch category and continue to deliver both hardware and software offerings the consumer finds compelling. Fitbit sold 2.7 million devices in the second quarter, up sequentially, and with the year-over-year rate of decline in devices sold dropping to 20% in the second quarter versus 27% in the first quarter. The success of Versa has improved the company's positioning with retailers, solidified shelf space for the Fitbit brand, and has provided a halo effect to our other product offerings. Retailers have been looking for a counterbalance to Apple, and Versa has delivered. In the second quarter, Fitbit Versa outsold all Samsung, Garmin, and Fossil smartwatches in North America combined. With a strong consumer receptivity for Versa, demand has outpaced supply, and we have chosen to add an additional production line. Since launch, we have also seen a significant uplift in North America POS trends. We also believe the channel reduction of trackers has run its course and have increased confidence that Q2 will mark the trough in the year-over-year decline in tracker sales. Our confidence in the trough in the decline in tracker sales is driven by clean tracker channel inventory levels, consumer feedback, and our product pipeline. As we look forward, we believe our improved forecasting and lower risk approach to new product introductions reduces the risk of an imbalance between sell-in and sell-through and gives us confidence in the path ahead. In the second quarter, 60% of activations came from new users, while 40% came from repeat buyers. Of the repeat buyers, 51% were previously inactive for 90 days or more. The percentage of repeat buyers coming from previously inactive customers has significantly improved from 39% in the second quarter of 2017, demonstrating that our newest devices can re-engage inactive customers and bring them back to the Fitbit platform. We have always emphasized there's no one-size-fits-all when it comes to health and fitness, and we have always provided a choice for consumers across form factor, feature, and price. While smartwatches continue to grow at a rapid pace and present a strong opportunity for future growth, there is still a large community of users who prefer the tracker form factor and who are looking for powerful health and fitness features at a more accessible price. For example, we sold 50% more Ulta HR devices in the U.S. during the 2018 Amazon Prime Day than the prior year. In addition, our Charge franchise has sold over 35 million devices, and Charge 2 continues to be our best-selling tracker with over 15 million sold nearly 2 years after it launched. Industry analysts also note that trackers will continue to be an important part the wearable categories overall. According to IDC, sales of trackers are expected to reach 46 million units in 2018 compared to 43 million smartwatches globally. we see an opportunity to reinvigorate the category through innovation to successfully serve the needs of this large consumer segment. Fitbit Ace, a recently introduced kids device, is a great example. With this product, we are introducing a wearable to a younger demographic while making fitness fun and helping families connect and build healthy habits together. In addition, we continue to invest in our social and software features. We believe our active community of users provides a barrier to commoditization and a unique value proposition. 56% of our active users viewed the feed in the second quarter. Our recently introduced female health tracking feature has also been well received with more than 2.9 million signups. We know that wearable devices can help people get healthier. The question now is how these devices will continue to evolve and what role they will play in healthcare. We have been working to lay the foundation for growth into the healthcare channel by strengthening our relationships with key players in the healthcare ecosystem, building out our direct sales team, adding capabilities like our Human Coach platform, and collaborating with developers to create health-focused apps and clock faces. The strength of our consumer offering and our ability to engage people and drive behavior change directly supports our healthcare efforts. We see ongoing evidence that healthcare use cases continue to grow and evolve. Some examples include payers embracing wearables and providing financial incentives to motivate behavior change, condition management, clinical research, or connecting patients and care teams. I'm proud to say that as of today, Fitbit Health Solutions has the ability to provide solutions to over 100 health plans across the U.S., including Blue Cross Blue Shield and Humana. In terms of clinical research, we continue to help researchers pioneer new ways to use our devices to drive better health outcomes. In a new study, researchers from Cedars-Sinai Medical Center and Johns Hopkins University found that a Fitbit device successfully gathered real-time objective data on patients with cancer, helping clinicians predict outcomes. We are also expanding the work we are doing with the University of Michigan's Intern Health Study, which this year will follow 2,000 new doctors to better understand how intense and changing work schedules contribute to a resident's mental health. When it comes to health, we want to leverage the investments we are making across both our consumer and health solutions business. As such, we are focused on chronic condition areas that have corollaries on the consumer side: diabetes and weight management, heart health and fitness, sleep apnea and sleep quality, and mental health and stress. Our ultimate goal is to help providers, health plans, and clinical researchers better support their patients outside the walls of the clinical environment and help our users better understand their overall health and wellness. We often receive testimonials from our customers telling us how their Fitbit devices either raised awareness about a potential medical issue or changed their lives by changing their behaviors. These examples include a young mother of 3 who identified that she had a serious condition called postural orthostatic tachycardia syndrome, or how a teenage girl discovered she was suffering from supraventricular tachycardia, a defect that causes a faster than normal heart rate due to an error in electrical impulses. It is these type of testimonials that give us confidence that we have the building blocks to create a device and software offering. We also introduced a number of key health apps in Q2 that brings important health information like blood glucose numbers to the wrist, helping to bridge the gap between consumer and healthcare. As part of this program, we introduced new health partner apps and clock faces, including Walgreens, OneDrop, and Limeade. Built using Fitbit's software development kit, the apps and clock faces will give Fitbit smartwatch users new options to improve wellness and help manage conditions like diabetes. Wearable devices are easy to use, unobtrusive, and motivating, while the benefits of increased activity and health awareness come with virtually no side effects. Finally, before turning the call to Ron to discuss our financials in more detail, I wanted to discuss our operating efficiency. We continue to be on track to reduce operating costs 7%, but made a conscious choice to pull forward costs and increase our media and advertising spend to support the launch of Versa. As I mentioned earlier, Versa's success strengthens channel partner relationships and we believe provides momentum into the back half of the year. Also, we continue to make progress transitioning our data infrastructure to Google's cloud, where we expect cost savings to begin in 2019. I am also excited to announce that we have hired a new leader for our engineering organization, Kobe Avital. Kobe joins us from Priceline.com, where he was our Chief Technology Officer. As Executive Vice President of Engineering, Kobe will focus on hardware, software and firmware engineering. Eric Friedman will maintain his role as CTO, focusing on data, security, and advanced research. With that, let me turn the call over to Ron to discuss the quarter in more detail. Ron?
Thanks, James. My prepared remarks will be focused on a financial overview of the second quarter results. I will then provide our guidance for the third quarter of 2018. Before I go through the details, I would like to remind investors that all financial references are to non-GAAP measures, except for revenue, unless I specify otherwise, and all financial comparisons are on a year-over-year basis, unless otherwise specified. Fitbit sold 2.7 million devices and generated $299 million of revenue in the quarter, down 15%. The 15% decline in revenue resulted from a 20% decline in devices sold, partially offset by an average selling price increase of 6% to $106 per device. The average price of trackers sold declined year over year, driven primarily by a mix of fewer Blaze units rather than competitive dynamics. Versa sales at an average selling price higher than Blaze more than made up for the tracker delta. However, with Versa contributing the vast majority of smartwatch sales in the quarter and having a sales price less than Fitbit Ionic, smartwatch ASPs declined from the prior quarter. Accessory and other revenue added an additional $5.23 per device sold. Accessory revenue was negatively impacted by fewer units sold, while non-device paid revenue grew 34%, but remains immaterial to overall results. U.S. revenue represented 61% of total revenue, or $182 million, declining 8% in the quarter. International revenue declined 24% to $117 million, but growth varied significantly between regions. APAC revenue advanced 66% to $35 million, while EMEA revenue declined 39% to $66 million, driven by higher promotional activity and weakness in the UK market. The UK market has lagged in its transition to smartwatches and thus was disproportionately exposed to contraction in the tracker market. We expect a reversal of this trend in Q3 and a return to growth. Americas, excluding the U.S., declined 35% to $16 million. As James indicated, broadly speaking, retail channel inventory is relatively clean, with some Versa demand unable to be fulfilled given supply constraints, and tracker inventory now in line with expected consumer demand. Our direct consumer business, Fitbit.com, represented 14% of revenue and declined 9% to $43 million. Gross margin declined 210 basis points to 40.9%. Decline was expected, driven by the growing mix of smartwatch revenue, partially offset by lower warranty costs and lower customer support contact rates. Operating expenses increased 1% to $194 million. Research and development costs increased 6% to $72 million. Despite an objective to lower operating costs, we are maintaining our investment in innovation to transform the business. Our goal is to drive efficiency in our device business while investing in software services and Fitbit Health solutions. Sales and marketing costs were flat year over year at $96 million. We increased investment with higher media spend to support the launch of Versa, but benefited from the improved quality of our devices. As DPPM has improved, case volume has shrunk, leading to lower customer support spend. In addition, we spent less on point-of-purchase displays. General and administrative expenses were $25 million. In addition, we have reduced our real estate footprint in San Francisco. This not only lowers our operating expense run rate, but removes approximately $81 million in lease obligations from our future commitments. Operating loss was $71 million, with other income of $4 million. We recorded a tax benefit of $12 million, resulting in a net loss per share of 22 cents in the quarter. Cash flow from operations was a negative $67 million, and capital expenditures in the quarter were $16 million, resulting in a free cash flow loss of $83 million, better than our expected free cash flow loss of $85 million. We ended the quarter with $580 million in cash and short-term investments and no debt. In addition, on July 3rd, we received a $72 million tax refund payment from the IRS. We expect to receive approximately $8 million in additional tax refund payments, but the timing is uncertain. Now let me turn and address our guidance. We expect third quarter results to benefit from the lessening in year-over-year decline of tracker revenue and continued growth of our smartwatch franchise. We expect revenue to decline approximately 3% on a year-over basis to a range of $370 to $390 million, and roughly flat gross margins to the second quarter. As a percentage of revenue, we expect Q3 operating costs to trend materially lower. We expect free cash flow of approximately negative $30 million in Q3 and net income per share between a 2-cent loss and a 1-cent profit. Our tax rate will vary on our ability to achieve profitability and the geography of income. We expect tax to shift from a benefit to an expense of approximately 2% and a basic share count of approximately 247 million shares. Stock-based compensation is expected to be approximately $26 million. We are reiterating our full year 2018 guidance. We have increased confidence that Q2 marked the trough in the year-over-year decline in tracker sales and anticipate continued strength in smartwatch growth. Similar to Q3, we anticipate gross margins to be roughly flat to Q2's at approximately 41%. The device mix shift will also benefit average selling price on a year-over-year basis, but will not offset the decline in tracker devices sold, and as such, we are forecasting an overall year-over-year decline in devices sold. Relative to Q2, average selling price is expected to be roughly flat. We expect to continue to grow our Fitbit Health Solutions business and increase our premium subscribers, but this growth will be relatively immaterial to our wearable device revenue. The net result is that we are maintaining our revenue expectations of approximately $1.5 billion. We are on track to reduce operating expenses by approximately $60 million from 2017 levels to $740 million, consistent with our previously stated commitment. Our intent is to continue to drive efficiencies into the business and redeploy capital to growing our software services, Fitbit Health Solutions, and international sales footprint. Given the strength of demand for Versa, we have increased our capital expenditure costs to increase production capacity and now anticipate CapEx to increase as a percent of revenue to 5% from the previously forecasted 4% level. We expect this spend to negatively impact free cash flow. As such, we are revising our fiscal 2018 free cash flow guidance to a loss of approximately $20 million from break even. Moving to taxes, we are forecasting fiscal 2018 tax of approximately 25%, but anticipate the tax rate to fluctuate substantially depending on the geographic distribution of our earnings. With respect to liquidity, given the shifting demand patterns and continued investment to transform our business from an episodic one to more durable sources of revenue, our primary focus in 2018 is to adapt to the changing wearable device market while creating the foundation to grow Fitbit Health Solutions and software services in 2019 and beyond. Our balance sheet remains robust, with $580 million in cash and marketable securities as of the end of Q2. In addition, as I noted earlier, we received $72 million in a tax refund in early July. We will continue to augment organic investment with targeted M&A. Similar to the acquisition of Twine Health, we expect M&A to continue to play an important role at Fitbit and are targeting businesses that will help transform our business toward digital health and recurring revenue. Before turning the call over to the operator, I wanted to take a minute to discuss the tariff situation. Fitbit utilizes contract manufacturers located in China to produce its devices. These devices, with the exception of our scale and headphones, are included in the tariff code identified by the U.S. Trade Representative's recent proposal. As such, a 10% tariff, if implemented, would apply to the bill of material costs on goods imported into the U.S. We are navigating a number of different paths to reduce or eliminate the impact of the tariff. It is important to note that it is unclear if the tariffs will ultimately go into effect, if wearable devices can qualify for an exemption, or how much, if any, of the potential increase in cost can be mitigated. Thus, our full-year guidance excludes the potential impact. We support open markets and free trade where everyone plays by the rules. With that, let me turn the call back to the operator to answer questions. Operator?
Thank you. If you'd like to ask a question, please signal by pressing *1 on your telephone keypad. If you're using a speakerphone, please make sure your mute function is turned off to allow your signal to reach our equipment. Again, press *1 to ask a question. We'll go first to Alex Fearman with Craig-Hallum.
Great. Thank you very much for taking my question, and congratulations on the huge success of the Versa. I wanted to ask about where do you kind of envision the role for the legacy wearable trackers in your portfolio over the next couple of years? It's encouraging to hear that it sounds like you're continuing to think that Q2 was the trough in terms of the negative growth rate. Can you give us a little bit of a sense of where that optimism comes from? I imagine some of that comes from the fact that the inventory in the channel appears to be pretty clean, but going forward on a more sustainable basis, can you give us a sense of where you see the role of the trackers in your portfolio? And specifically, I'd be interested to hear where you envision the distribution of these products. I think you mentioned that the success of the Versa really helped to strengthen the relationship with some of your channel partners. What are the channel partners most interested in carrying? Do you envision them likely carrying the legacy products over time, or do you see them more carrying the newer products and then selling more of the legacy devices on Fitbit.com? Just curious how we should expect to see that process unfold over the next couple of years.
Yeah, so we continue to be excited about the tracker category, and we expect trackers to be an important part of our portfolio for many years ahead. And the reason for that is several. One, there's no one-size-fits-all in the wearables category. There's a lot of nuance in consumer preference and choice between form factor, feature set, and price. And there's actually a large community of users based on our market research who still prefer trackers, and actually specifically trackers and not smartwatches. And it's a good thing that we lead that category. So we're going to continue to invest and innovate in trackers, and I'm pretty excited about our product pipeline in that category. And to give you some context, we've had a huge franchise since we've launched Original Tracker. 35 million devices for Charge, 15 million in Charge 2 since launching 2 years ago. So, it's going to continue to be important. Not only that, we're taking opportunities to increase where trackers can be sold. One is the kids demographic. Fitbit Ace continues to get positive momentum and reception. And then healthcare is going to be a big channel for us for trackers. The healthcare channel is more price sensitive, and our tracker lineup is perfect for distribution into our health plans. For retailers, because we feel pretty strongly that the year-over-year decline in trackers has hit a trough, they're going to continue to carry the tracker lineup along with smartwatches.
Great. Thanks, James. That's really helpful. And then if I could just add one follow-up, it seems like you have a very strong and growing community of users that are really engaging with the app, using the feed. Is there any discernible difference in behavior from those core engaged users that are using the feed? Are they more likely to gravitate towards the smartwatches or the trackers, or more likely to purchase on Fitbit.com versus a retailer? Just curious if that subset of users is behaving differently than the other users.
Yeah, they do behave differently. Where we see it is actually in terms of retention and engagement. Being involved in the community and being involved with your friends and family on Fitbit helps both of those metrics pretty materially. And where that's going to really manifest itself in terms of our future strategy is, as we roll out more services that are paid and attached to the core product, we obviously want very healthy engagement and retention numbers. And a great statistic for us on the paid premium front is inclusive of our Twine acquisition, our paid premium services actually grew 34% year over year. So that's a positive trend.
Great. Thank you very much.
We'll go now to Sherry Scribner with Deutsche Bank.
Hi, thank you. I guess just thinking over the next couple of years in the transition in the smartwatch business from trackers, I guess how are you thinking about potential unit growth as we move into 19 and 20, as we've sort of stabilized some of the declines in the tracker business, or at least the smartwatch business has become a bigger piece of the overall business?
Yeah, I think this is Ron. I think, if you look at kind of the mix we saw in Q2 with, trackers being, the smartwatches being, 55%, so a little over half. I think as you look certainly to the second half of this year and probably into early next year, I would expect that we would still see trackers, comprising a significant portion of those sales, and that the smartwatches would still be probably in that 50% range, maybe a little bit, increasing a little bit as part of the mix going forward. But trackers, as James indicated, there's a large community of users who prefer trackers. I think as you look at the innovation, you're going to see more of a blending of some of the features and form factors between the two. And in addition, particularly in healthcare and in the kids space, you're going to continue to see demand and new products and increased unit sales into healthcare.
Yeah, and as I mentioned in my prior comment, we need both of those products to be successful in executing our strategy, and they're a foundational element of, I think, a huge milestone, which is one for us to break even in Q3 and actually to return to growth and profitability in the second half, which is what we're expecting.
Okay, great. And then thinking about all of the new initiatives you have on the health side with sleep apnea and tracking women's health, I guess I'm asking, is there a way for you guys to monetize those opportunities beyond just selling a hardware device? Is there some way that you guys have been thinking about where there's some sort of service or there's some sort of other way that you guys can generate some type of recurring revenue stream maybe on top of the hardware sale?
Yeah, absolutely. We're very focused on building our recurring revenue streams, and that's going to happen on both the consumer side and on the healthcare side. So on the consumer side, we are investing in and thinking about creating a membership model for devices and having services that consumers pay for. And then on the healthcare side, the ways that we monetize beyond the device will be, one, selling our services, include diagnostics and coaching on a per member per month basis, or possibly even sharing in some of the cost savings that our products and services deliver. And I think one of the positive proof points is that our healthcare business actually grew at a double-digit rate in Q2.
Okay, great. And then just quickly, Ron, a clarification. The change in the free cash flow to be down and as opposed to flat, does that include the $72 million cash you got from the tax refund, or does it not include that? Thank you.
No, our free cash flow guidance excludes the tax refund of $72 million.
Okay, great. Thank you.
We'll now take a question from Jeff Garro with William Blair.
Yeah, good afternoon, guys, and thanks for taking the question. I want to ask a little bit more about the deepening in healthcare and maybe get you guys to talk a little bit more about the channel strategy and specifically how you view the health plan channel versus the direct-to-employer opportunity or maybe any other channel within healthcare.
Yeah, so our two primary go-to-markets for our healthcare business is our employers and health plans, and we're continuously adding to the breadth in both. I think one of the big proof points for us in Q2 was that the number of health plans that we work with now exceed over 100, including Blue Cross, Blue Shield, and Humana. And one of the things that we're trying to work with all these partners is, adding revenue streams beyond the initial device sale. So again, either on a per member per month basis, PMPM, or shared savings. And that's a big focus of the company.
Great, that's helpful. And maybe to follow up, I was hoping to get an update on the Twine acquisition, the integration of that, and how it can get healthcare stakeholders to engage more deeply in the health of their end users and ability to produce tangible results, like the cost savings that you say you might be able to share and then generate revenue.
Yeah, so the Twine acquisition has been going really well. We've gotten positive reception, again, from our employers and our health plan customers. And, just to repeat the stat that I had before, inclusive of Twine, our paid premium or recurring software business model grew 34% year over year. So we feel the integration is going well.
Great, thanks for taking the question.
We'll now go to Scott McConnell with D.A. Davidson.
Great, thank you. So you talked a little bit about the difficulties in the UK, but how did growth in EMEA outside of the UK look? And then maybe can you discuss what exactly the hurdles are in the UK with getting users to switch to smartwatches from trackers and how you're addressing these challenges?
So this is Ron. So across the EMEA, we don't typically break out, each country individually. What I can say is that the decline we saw in Europe was driven, primarily by declines in the UK, which is one of our largest markets in the UK. And what we saw there is, in the quarter, they were impacted by their relatively high exposure to trackers. That was the predominant, portion of what they were purchasing. And so when we saw the reduction in the tracker category, they were disproportionately impacted. I think the one positive thing that we're seeing is unlike when Australia and the U.S. went through this category correction, we have this alternative with the smartwatch product that is been well received. And so we expect the decline that we saw in the region to be less, and we expect the rebound to be much faster than what we saw in other regions. And as a result, we're expecting to see a return to growth in Q3 in the region.
Okay, great. Thanks.
Our next question will come from Jim Suva with Citi.
Hi, this is Josh Keo on for Jim. Thanks for taking our question. What are your expectations for non-wrist-worn device sales, for example, your headphones and scale sales, and when could we see that becoming maybe a 5% or more percent of revenue? Thanks.
Yep. Yeah, I think as we look at those, I think we, at this juncture, those non-wrist sales, we would expect to see those, continue to be pretty minimal in terms of our sales, and in the foreseeable future to continue to be in that under 5% level.
We'll go to our next question with Joe Wittine with Longbow Research.
Okay, thanks. Ionic is going on a year since announcement. By all accounts, the reception has been pretty mixed. So when you look at that combined with the obvious success of Versa, I'm wondering how your strategy is evolving, if at all, on serving that high-end, GPS running market where there's some long-standing entrenched competition with high-end features. Like, I guess, do you think that you're getting the ROI and the resources you're directing to GPS-enabled, or could the niche down by the Versa mass market smartwatch area be enough for Fitbit to carve out more ground?
Yeah, so I'll just say, Ionic didn't meet our initial expectations, but, over the course of its lifetime so far, it is playing a very important role in our portfolio, and it's not something that we would get rid of. So when we talk about smartwatches being 55% of our revenue, that's a combination of both Ionic and Versa. Ionic is targeting the performance segment of the category really effectively, and Versa is targeting the mainstream portion of the category. So I feel that we still need both of those products in the mix.
Great. And then on OpEx, James, you referenced the move to Google's public cloud, which will carry some cost savings, and Ron, you mentioned the office square footage decline. I know you won't quantify 19 OpEx, but can you give us some directional comment on if these initiatives are enough to keep OpEx dollars flat or continually declining next year?
Yeah. I think for, in general, we're looking to drive, efficiency and leverage into the business. And I think, a number of things such as the Google Cloud transition, the, office space reductions that we did are very focused at driving, efficiencies, particularly into 2019. Driving that efficiency is we're going to continue to invest in software, our Fitbit health services as well as international sales. So I think we're looking at kind of a balance of those two, and don't have specific guidance for 2019 at this point other than continuing to drive efficiency in the business.
Okay, and then finally, you may have answered a little bit of this on the UK question earlier, but how do we interpret EMEA returning to growth? Because I think in your tracker-only days, the company used to view EMEA as lagging the U.S. by a couple of quarters. I think it's an interesting data point, and I don't know if is it maybe an easier comp or quicker smartwatch adoption in EMEA versus the U.S. today?
Yeah, so as Ron mentioned before, and then as you just mentioned, EMEA does lag the U.S. markets. I think the positive thing is as it goes to this shift in the wearables market from trackers to smartwatches, we do have a great product and product lineup in both Ionic and Versa to help mitigate that. And while we don't break it out specifically,
we are seeing very positive momentum for our smartwatches outside of the U.S., EMEA and APAC. So, that's what's giving us confidence in our statement that we feel that the region is going to return back to growth in Q3.
Is EMEA where smartwatches are the largest portion of your unit mix, geographically speaking?
No.
Okay,
the largest portion of our smartwatch unit mix is in the U.S.
Got it. Thanks a lot. Good luck.
We'll go now to Ryan Goodman with Bank of America Merrill Lynch.
Hey, thanks for taking the questions. I have two. First one, really nice job on the quarter. But I did have a question. So you beat the quarter versus expectations. The outlook was also pretty good, but you reiterated the fiscal year guidance. So I'm just curious, this seems to imply more of a conservative posture just on 4Q versus where you would have been a quarter ago. So first, just any thoughts on that? And then second question, just on the gross margin guidance for the year to hold flat with Q2 levels. Previously that was expected to decline over the course of the year. So is the implication that smartwatches kind of stabilize at this 55% of revenue level, or is there anything else playing a factor there? Thanks.
Okay. I think on the guidance, a couple of things. Part of it is to de-risk the year in terms of looking at guidance. The majority of our sales still occur in the second half. So I think it's prudent not to be raising guidance, but we have increased confidence around our revenue guidance of $1.5 billion. And I think particularly given the positive momentum in Q2, it significantly reduces our risk around our 2018 commitments. I think in terms of gross margin, if you kind of go back to the beginning of the year, your Q1 margins were higher. Part of it was due to reserve adjustments associated with Win It, and so we did expect that the rest of the year coming off of Q1 would be lower. I think based on the gross margin levels that we saw in Q2, at right around 40-41%, are where we would expect to be for the rest of the year. So we expect them now to run flat for the remainder of the year. I think we also saw trackers, in Q2 was kind of the trough in terms of their demand, which also impacted margins in the second quarter.
We'll go next to Yuji Anderson with Morgan Stanley.
Great. Thanks for taking my question. On the Q3 guide, appreciate that you mentioned that the Versa had a sellout in Q2. Is there additional channel stocking activity built into the Q3 guide versus perhaps an additional product launch?
Yeah, I think in Q3, as we indicated, we were sold out in Q2 on Versa, so there would be some amount of additional stocking. Twofold. One is as the additional supply comes online, and secondly, as we get toward the late part of the year and we get closer to the holiday season, that we'll continue to add and build inventory back to what we believe is a healthy level in the channel.
Got it. And then a quick question on Twine and the continued investments in direct sales there. As we model out OpEx, should we be expecting some incremental hires to close out the year? And related to that, how should we think about leverage off of those investments? Thanks so much.
This is Ron. I think first off, in terms of just kind of looking at overall headcount, I think broadly speaking, we're focused less on the level of headcount and driving OpEx efficiency. While we redeploy resources in growth areas of investment, such as health services, Twine, and international, and broadly speaking, as we indicated, we do expect to continue to achieve our $60 million reduction in OpEx versus the prior year, and come in and hit our $740 million operating expense commitment for 2018.
Thanks so much.
We'll go next to Scott Searle with Roth Capital.
Hey, good afternoon. Thanks for taking my question. Nice quarter, nice outlook. I apologize, I'm late to the call, so I apologize again if this was already covered. But in terms of the outlook for the second half of this year. I think you had spoken previously about 50% of the mix coming from smartwatches in the context of 55% in the second quarter. Have your thoughts on that changed at all? And in particular, I heard the positive commentary talking about trackers and returning more to a growth mode and playing an important role. So I'm kind of wondering how you see that sequentially progressing both into the third quarter and fourth quarter with some seasonality, but also from a product portfolio standpoint on the smartwatch front. How much do you have to broaden it to start to hit all the different buckets out there? You certainly have high performance, and Versa has been a huge success in terms of the middle market. But other areas such as cellular connectivity and otherwise, where does that fit into the overall thought process for the portfolio? Thanks.
Yeah. So I'll take the first part of the question in terms of the mix. I think we still expect the smartwatch mix in the second half to be, around 50%, around what we saw in Q2. I think part of that's driven by, as we noted, Q2 marked the trough in year-over-year declines in trackers. So we would expect, the trackers to improve in the second half over what we saw in Q2. And so given the improvement in trackers, we expect it to remain basically flat in line with that 50%.
Yeah, and in terms of the overall smartwatch portfolio, we have Versa and Ionic today, which target two very different segments of the category. But we do feel there is opportunity to expand the lineup at some point and address additional needs. And we feel that those will be incremental to the overall lineup.
Thank you.
And we'll take our last question from Charlie Anderson of Dougherty.
Yeah, thanks for taking my questions. I wonder on smartwatch gross margins, if you could maybe address sort of the long-term trajectory that you see there. Are there opportunities to increase ASP over time, or is it going to be a situation where ASP goes down to broaden the appeal? And then on the cost side, what do you see happening there that's maybe identifiable to help gross margins there? And then I've got a follow-up.
Yeah, so on the ASP side, it kind of relates to my prior comment. We're looking at different opportunities and additional opportunities in the smartwatch portfolio, so that's clearly going to affect the ASP. It's a little too early to comment how that's going to be affected, but it most likely will.
And
I think in terms of I think on the cost side, I think there's a couple of things. Certainly, as we expand our production, yield improvement will yield some improvement in gross margins. I think at this point we have clear visibility for the remainder of this year, but in terms of them seeing flat. But I think through yield improvements, product mix, some of the new products that James is talking about, I think there's an opportunity to drive efficiencies there.
Great. And then for my follow-up question, you mentioned how you've with Versa really allowed yourself to be sort of that second brand next to Apple. And I wonder, over time, do you feel like there's leverage off advertising here? Can incremental margins on the smartwatch business get better over time? Will you need less advertising to support it maybe than we've seen in some prior launches? Thanks.
Yeah, that's definitely a possibility. I think one of the things that we did in Q2 to support the launch was invest more heavily in sales and marketing. And we do expect that investment in brand awareness to have benefits as we enter the second half of the year. So I'd say overall it's a very positive story. The success of Versa creates a positive feedback loop between ourselves, our customers, and the channel. And it's providing an overall halo effect and lift in brand awareness and product strength across the board.
And this concludes today's call. Thank you for your participation. You may now disconnect.